Good afternoon, traders. Hope we're all doing well today. Been a lovely Friday. Well, at least if you're down in Melbourne, it's probably not so good. It's been raining all morning, so I think the sun's just starting to peek out behind the clouds, but we're not looking good for the weekend either way. Um, Been another big night overnight in the US. Another good, well, not as big as the previous few nights. Well, at least night previous. Market was up again, made some new highs. I don't know if they made a new high. A new all-time close, high close, or it was just intraday again. I think the previous session they made new highs intraday and then closed off a bit, but it was a big session, and then we backed it up obviously last night. Uh, Backed it up with another decent session, so it was up slightly, not a lot. Um, but yeah, one thing that is moving, and we'll show that in a minute, is the DAX. The DAX has been flying the last couple of sessions. It was up over, I think, up another 200 last night, if I recall. Um, Memory's not the best, so I'll just check on that. I'm pretty sure that's had a couple of good nights. That backed it up. The night previous, it was up about 250 or so, and then last night it was up another. It was another big night. I'll just check to see. Anyway, not to worry. Yeah, what we've got here again is our homepage there. The Trade Setup live stream. So we've got the Trade Setup app for you that don't know. You can view everything on. You can join us on Twitter. We don't send a lot out on Twitter, but we do alert to different things that could be of use. We've got Facebook. Follow us on Facebook, or just join in the fun on YouTube. So if you subscribe on YouTube, you actually get alerts to saying we're actually going live and we are streaming. So jump on there if you can, and yeah, feel free to like us if you do like what we're doing or what we're seeing. We've got the general advice warning as usual. Just go through that and take your time to read through that. We don't give personal advice, so anything we discuss is really just our own opinions and what we've learned in the past, especially on charting. We're not giving advice on which way we think it's going. Well, we're saying our ideas and based on what we're seeing, what we think is going to happen, but it's like I said, it's just general advice only. Well, let's kick it off. Let's get into it. So I hope we're all doing well today. We've had a couple of good days. It's been a strong couple of sessions, as you know. The ASX has really kicked on, so we've got to, and we know it. We know it's going well because the positions we got through the Trade Setup app and the alerts, we're really loading up at the moment. We normally only like to do up to about 10. I think 10's a comfortable position, number of positions, and that's what we're finding. We'd never hit 10 just yet at one time, and I mean I'm sure we probably could have if we put out a few more alerts, but and we found that we're sort of, if you're down at 3 or 4, or even we've been down at 1 at one stage for a very short period of time. So when we see the market starting to move and doing things, we're finding positions setups are starting to trade and they're starting to move, and we've seen that when our numbers that start picking up towards 10. I think at the moment we've got I'd say 8, maybe actually 9. We just got one on today. What was that again? Let me just CIM. So if you can see that, that's just kicked off. It's about where we said we wanted 31.76, I think, which it just touched above today. But that structure there looks quite nice. You can see it's been making lower highs, making some lower lows as well, and it's just starting to hold up some lower lows. Hold up through 27, made a higher low in here, and just taking out some of these minor lower highs, and it's just starting to perk up. So it's a key level up towards that 32, and it's just pushed its head up. You can see that resistance level there, this sort of lower high in here, held up on support, and it pushed up through there a couple of days ago, on the 28th or thereabouts. So it's just broken that. So we would expect to bring in some buyers. So we've just got in there. We've got our risk quite tight, and we're happy to see if that can push back up to say 37, even retest those highs. You can see on the weekly. Let's go back a bit more, up towards 40. It's probably going to provide some strong resistance, but if it gets through there, I think it's just going to go. So we like that one. Anyway, the other ones are going quite well. We've got SLRs kicking on. We're in that one from 57. That's kicking on. We said once it gets through 64, I think that's off. That's going to continue. You can see that weekly. You can see that's kicking on quite strong. So I'd expect that weekly trend to really continue high. And you got 70. If it gets through 64, you're sort of targeting 70, and then from there you target up to about $1. So there'll be really good risk reward on that one. So that's it. Let's kick it. Just have a look at the ASX. Let's just push it over. I'll just get the charts up now. Fine, that trend is still just ticking along nicely. It's kicked on nicely. It's got through that. We had that big correction, I remember, off 55. After we pushed through initially, pulled back, retested it, made a lower low, and then we just picked up, made a nice little base there. So that area there was a really nice area to trade off on the 30-minute chart anyway. You can see it's pushed back up 53.83, consolidated for a bit. So anyway, sort of the bears would expect that to roll over. You can see a couple of good down days were bought up. Good sharp down move. It's like half an hour chart move. Half an hour candle there. It's pushed down, popped back up quite strong. And then we did it again, retest that low, and then just picked up from there. So that was a really nice area to trade, looking for expansion back up to 5,500. And it's turned out quite well. It's just blown straight through that, doing nicely so far. We're expecting that to just continue higher highs, high lows, and work its way up to 5,600, where I'd expect to see that would find a bit of resistance up there. If we can just do it on just get up this. You can see that ticking along nicely. We're going to expect a bit of resistance up towards 56, probably find a bit of reaction off that level, but we'll see how it goes. It could just blow through. I mean, this is a good little setup. You can see this, the contraction lower down to 54. Maybe enough springboard, give it a springboard effect to push straight up through 56 and just blow through it. Everyone's probably expecting that to, back off from there. So anyone that hasn't got in to positions have been holding off, been a bit tentative. If it pushes up through there, they'll probably be chasing the market up, I'd say. So it'll be interesting to see what happens there. Let's take a look at the DAX. I just wanted to go over that quickly. Just technically, you can see that's a daily chart. It's looking, it looks good. Won't lie. It looks nice. We'll just draw it up. I only just looked at it a while ago with those moves. You can see, the zones. It's probably a major support through here. Let's just get rid of that. A major level through here. You can see we're heading potentially up to new highs again. That's really backed off. Obviously, what's that since early mid 2015 after making those highs, backed off, contracted right back down to those lows. And you can see that was a key level, pretty much a key level at 83.45 that held that leg up. We contracted down, so that really that daily uptrend is still holding. We've had that strong push higher, and like we said before, good sharp vertical move near vertical, considering the slope of this move up here. It contracted and then the slope's just changed. It's gone near vertical. So that you probably generally you would expect some good a good contraction lower, and you've seen that. And what we've got through here, you can see that breakout through there. It's just sort of consolidated, washed out through here, even tested down, washed out the low there. It's really contracting. Once we got this high low in here, bang, you can see the last few days have been solid, really nice. So the next port of calls probably might find a bit of reaction off 11,440, say, and then I'd say it's probably going to be up to test those highs at 12,370 or thereabouts. But that's looking good. Technically looks great. Just taking into account this overall more contraction lower, this overall move lower contraction. We've built that major high low just in here, and it's just pushed it up through some key levels. The next key level is obviously 11,440, 450 zone. So we'll see how we go when we get up there, but looking good. Just continuing on with this US Trump rally. Anyone trade the DAX? There you go, Nathan. Do you trade the DAX at all? Have you traded it in the past? Hey, yeah, Davin really gave it a good nudge. He loved it. I've given it a go in the past and got some great results off it. You get that volatility. When you get it right, you know it pretty quickly. When you get it wrong, as long as you got your risk defined, there's times you can easily. It's got enough volume going through too that you can really you don't get whipped out too much. I mean, I use hard stops anyway when I was trading the DAX. It's very fast. So I know myself. I like to use my hard stops in there. Yeah, it's great. Anyway, let's kick it off now. We had a request to talk about options. It's something I've traded a lot before, probably for a fair few years. Traded all different styles into the options, different strategies and things like that. I think we had a request. Someone's actually wanted to get into. I think it's Paul, looking at trading options and using options as a tool to trade the market. Um, I think they're great. I think there's so many different combinations with options as long as you understand them, and there's a few key things that I look for when I trade them. Um, it was a morning Australia time. Okay, that's cool. Yeah, Paul. It was Paul. Yeah, but I think it was a great topic to talk about. If anyone else actually trades options that had interest, I'm assuming we'll talk about stuff today, but I'm assuming um, most of you know the basics, like what a put and a call is. What selling a call means and what buying a call means, as opposed to doing the opposite on selling and buying a put. Um, I'm assuming that's just those basics. A lot of people probably know a bit more than that. The Greeks. The Greeks are just different factors that go into making up the pricing of the option, and a lot of people who get right into trading options and different things look at the Greeks. I used to look at one, basically the delta, if anyone knows that. I didn't get involved and look at the others. I reckon that was starting to muck around with them too much. And you just make things too complicated. You start taking your eye off of what the actual market's doing. Um, all right, to kick it off, the way I would view options, great tool. Like you can do any different combinations, and people have probably heard that you can do straddles. Geez, I don't even know what you call them nowadays, but condors, all this sorts of stuff, vertical spreads, calendar spreads. You can do all sorts of stuff. So it's like a little chess match, I guess. The way you put your options together, whether you're getting a credit spread, a debit spread, how you're attacking the market. But what it comes down to, for me, is really you've got to you really have to have an idea of what the market's doing. So, say this is just take into account, this is the DAX still. The way you would have attacked it through here may be different to the way you're attacking it now. Because of what the markets do, the market characteristics. So you really do have to take into account, you have to have a view of the market, I guess, is what I'm trying to say. You have to think about which way, is it going up, down, or sideways? If it goes sideways, what are you going to do? If it's trending higher, what are you going to do? How are you going to use options? If that's your tool you want to look at, how are you going to use options to make money? Um, is it a volatile market? Volatility is a big thing into options. I think it's a massive thing, and I've used that on oil in the past. Volatility was a key thing of when I was trading, and when volatility disappeared out of crude oil, it sort of killed that trade and what I was looking at doing. So we'll describe that in a minute. So you got to have an understanding of, is the market trending? If it's going down, how do you want to structure your trade using the options? If it's going up, how do you want to structure your trade? And again, if it's going sideways, because that sideways market, you can sort of define your range. You can get up here, you can just hits up to the top end. You can either sell a call, which takes advantage of the market going down, or you could buy a put, taking advantage of the market going down. And when it hits the bottom side, you can buy your put back, or sorry, you can sell your put back, or you can buy your call back. So calls, just think of it, calls take advantage of a move higher. Well, buying a call does so. And then selling a call is the reverse. You want the market to go down. Buying a put, you want the market to go down, and selling a put, you essentially want the market to go higher. So if you can there's probably enough stuff on Google of just to give you an idea of what you want to do. But yeah, like I said, you got to have a key. You got to have an understanding of what you think the market's doing. So let's just describe what I used to do on options. So you can do, if you're attacking this, you can, like I said, you can add your different options together. You can do what we call naked options. Naked means you just not really, you're not really buying a naked call. You're selling. So when you sell, if you sell it naked, it means you've got no protection. So if you sell a call, and if you happen to sell a call up here, your strike price might be 1100. All of a sudden you're underwater and you're copying it. And depending on um, where your expiry date is, uh, you've got to be careful. So selling naked calls is traditionally the most riskiest way to make money, because it's unlimited downside. All right, and that's the way it's viewed basically. But when you buy, if you bought a call here, you're looking for that breakout. You might have done it a few times, but if you bought a call thinking, oh, we're coming off a high low, if it gets up here, I might buy a call in here just to You know exactly what your risk is. Your risk is what you paid for the call, and then unlimited gains on the upside, obviously up until still legal. Yeah, yeah. On futures anyway. I don't know how it's. I think it's all good. Anything traded through the exchange, as far as I know, yes. Um, so what I one actually I'll get the other chart up there. That's easy to draw on. One thing I used to do on crude oil. Everyone knows crude what it was back in when was it? Oh, I forget now. Before the GFC, we got hit a bit through the GFC, and then we started making money again because crude was quite strong, and crude went from about $60 a barrel up to 148, $150 a barrel. The thing that really makes up the price of the option is your volatility, and that's when the market's really volatile. Your prices on your options are going to be higher. All right, so if the market's uh, essentially going up sharp, having minor corrections and going up again, and you're just getting that volatility. It could have big swings, then it goes bang, that sort of thing. That's what crude was doing back then. So the volatility increased a hell of a lot. So the price of the options increased a lot as well. So generally, short calls through CFDs. To be honest, I'm not 100% sure. I don't think so. I know CFDs, shorting CFDs got switched off for a while. Um, I know that happened. I don't know when that happened. That was a while ago. I know in the US, it might be a bit different. I'm not sure their rules and regulations over there. Um, there might be with equity options selling naked calls. Um, I don't know about buying naked. Selling naked puts means just selling the puts with no protection on them. I don't know if that's because that's actually a way to get into the market if you're talking stock options. But selling naked calls, it is like a short position, so they may have banned that for a while when the market, you know, especially when the market was getting crucified. But when the market's going down and you're selling calls, it doesn't really do much. You're just taking the income from the call. So back to what goes up into making an option is the volatility. Volatility is a big thing. Um, so the higher the volatility, the higher your price. So really, the higher your price, you don't really want to be buying options. That's my general view. I would prefer to sell them and take the credit from selling. It also means you can get further away. Your strike prices, you can get further away from the market. You can get yourself out of the risk. So essentially, your delta's, I viewed it as a risk on my option. So the lower the delta, the lower the risk. The higher the delta, the higher the risk. Right? As a um, general way to view it. Now, crude at that time, I could get a nice low delta. My strike prices were miles away from the market, and I was getting say 30 to 40 points. I was only a month away from expiry, whereas now to get 40 points, you probably have to be 3 months away from expiry, and you have to be a lot closer to the price because the volatility's disappeared, especially out of the calls. So doing what I did back then, it's not going to work now. But there's maybe a time it will because the market's been, consolidating between say 40 and $50 a barrel for a while now, really doing nothing. It's been heading south, been grinding lower. So the volatility's come out of it, whereas back then it was just shooting up. It was just a euphoria. The market was going nuts. Um, so selling calls, all I did was sell naked calls. It was like I had a view that every time it spiked higher, so I'm still taking a view of the market overall. I'm not just trying to I still underlying the first thing we'd do is look at the market. If it's contracted back, I wouldn't even bother selling a call because I know that the chances that it was going to spike higher again were getting high. The more it was contracting lower because it would just really take off. But when it took off and it really extended higher, it's just the opposite scenario. So for the probability of it keeping going high and not stopping was diminishing. So all you do is sit there once it spiked higher and it really looks like it's run out of steam, go and sell some calls because you sell them for 40 points. 40 points then was, I think, 400 US an option. I'd do a couple of hundred at a time. And then if it pull back, you get that pullback and you just trade them. So as soon as it pulls back, it looks like it's running out of steam. It may spike again. You get out, you buy them back. You might buy them back at 20. And then you're booking basically 200 US an option. Now, you could do that same option about 2 to 3 times during the month, whereas nowadays, no chance of doing that. So that was just one way to attack, the volatility. You're just taking advantage of a very volatile market. Now, like I said, if you've got a market that's more ranging, it may push down between support and resistance and then bang back up. Um, you don't get the volatility in that is not high. So you've got a market it's really just moving between support and resistance. So that attacking that selling calls is probably going to be a bit worthless, and your risk reward is really it just turns around on you because if you're selling them in a low volatility, you don't generally, like I said before, in a high volatility environment, you wouldn't buy options in my view because you're paying too much of them. Um, Obviously, there's different markets. The way you attack it or the reasons for doing it might be different, but generally the way I look at it, I wouldn't buy them. I'd look more to sell. I'd want to be taking advantage of the income in a low volatility environment. Uh, like something that's range trade and it's spent a bit of time. It's maybe, or even something that's just grinding higher. It's got low volatility. Um, I'm not too concerned about selling. I wouldn't sell because the risk that it starts turning into a high volatility environment, that's where you can get caught because you don't. If I sold a call up here, for example, and this market was just contracting, um, is this making sense to everyone? So what I've got here, I've got that move up, and that's been a strong move higher. Say daily, weekly, whatever. The market's contracting. We don't know what's going to happen, and the volatility comes out of the options at that stage. This market's going through, it's contracting. What it could be doing is just building a base. So as the volatility comes out of the market, um, but the price there to me is building a base. I would just be the reason why I wouldn't sell options in that respect because if it starts popping up and then you get the volatility spiking and you sold an option, all of a sudden you've got and you sold a naked option, especially you're selling just trying to generate the income. Um, that's when one you get caught, the market moves against you, and two the volatility moves against you. So what the beauty of what I was getting with crude oil is that the volatility was very high, so that as it comes into expiry, that not the volatility that the price has got to go to zero. All right, if it's out of the money. So as the price of getting price going in my favor, and I'm getting the market going in my favor, and if the volatility it struggles to go higher when it's so high, it's more than likely if the volatility comes out of the market, I'm getting that adding to my price. I'm making money from that. So there's a lot of reasons when you're selling at a high volatility, how you're going to make money. You don't do that. You try to keep away from that in a low volatility environment. But attacking this with board options, you've got your idea of what the market's. It's going into contraction. It's starting to build some higher lows. Holding some higher lows through here. You can easily attack that with buying an option. All right. So just reading that, Paul. Of a selling option is that if the price moves a long way, you potentially miss out on a lot of money. You get the premium, but nothing else. That's right. Um, that's what I mean. We'll get to that. You can sell it to close and potentially make good money. Yeah. So there's different ways of taking the money. What I was saying here, I would not have bought options there because it's too risky. You're getting chopped. I just found it really easy to sell the options. Every time it's spiked. But in this type of scenario, I'd be happy to buy an option here. Your volatility's it's gone up a bit. The volatility's come out of the options. Okay, so we're just talking about options come out of the market a bit. You got these smaller moves, prices contracting, volatility's come out. If you bought a call here, as opposed to you could buy stock. I mean, that's just if you're trading using options only, because it's a leveraged way to get into the market. Don't forget as well. If you bought a call here and then you get price appreciation. All right, so price is going in your favor. If you buy a call, you can sell puts too, but again, low volatility environment is probably not the best strategy. I would be buying calls in this type of environment, trying to attack that movement, and then you get obviously price appreciation, and then you get maybe volatility expansion. Then you get some bigger moves. You can see some, um, say this type of scenario when you get the candles are bigger, the volatility comes in. Um, you're taking advantage of that as well, right? So you're getting it's like a double bang for your buck. When the market's fairly even and the moves are fairly even, there's not much volatility. The market can just sort of perk up, consolidate, and then go. But it's all it all happens on an even scale with regards to volatility. So you do get price appreciation, that's great. But there's sometimes when you get it like this, when you've got a really, a market that can move and it's moved up, it's consolidated, volatility comes out, you buy some calls, maybe you're buying a few calls through here at low volatility. You know exactly what your risk is because it's exactly what you're paying for it. I mean, that's the maximum risk. You can always get out of it. If the market rolls over, you just trade it like you normally would trade the stock. You get out of it, you close them out, you take the hit, you don't take as big a hit potentially as what you do with the stock. You don't have to have as much money as buying 100 grand worth of the stock. You can trade 100 grand's worth with the options. Well, probably a hell of a lot more. It's probably 10% of that. I'm just as a rough guess. I don't know the prices and what we're talking, what stock obviously. But then you've got the option of really taking the price appreciation depending on what strike you get, and you've got the volatility. The volatility kicks up; it helps your price as well. So everything's moving in your favor. Does that make sense there? So you're right, Paul. Selling options it's only conducive to one type of market. You wouldn't sell them in a ranging market. I think it's a bit tougher to do. I'd rather just be buying and just trading the market using options. But there's times when a lot of people do covered calls. Well, that's probably not what I was going to say. I meant to say covered options. So you sell a call and you buy one higher. So all you're trying to do is get the credit. Now that's one strategy. But again, to me, it's got to do with volatility. If it's a low volatility market, then you get yourself caught because everything can move from low volatility to high volatility and back again. They swing between low and high all the time. And we all know that when we get spikes in the market, up or down. Even if the market spikes down, your calls are going to go up as well because its volatility is just added across the board. Probably not as much as your puts. So if the market, got hammered, like it has in the past, it's just had these big 200-point drop and another 200-point night. Your volatility is going to spike. It's going to spike across the put side of it, but it's also going to spike on the calls as well. Yeah. So Paul, basically, you're trying to just get an idea of volatility in the market, and you'll be able to glance at that with a chart. So if I'm purely trading, what's this? This is Sydney. Sorry, I'm just seeing. Might be a good example. Um, you want to sell not sell options when it's spiked as such, but sell it if it's spiked and it's a high volatility environment. That's the way I trade, especially futures with crude oil. You got very good premium. It was awesome. Gold, I used to trade a bit of gold and Aussie dollar. Aussie dollar wasn't as good. Gold was okay. The crude just seemed to be the market at that time. It was unreal. Now you can't do the same thing, right? You sell calls now. All you're gonna, well, you make money. The problem is, what I might have sold a month away from expiry and for 40 points, I'll probably get 10 points and I'll probably be 2 months away, a month and a half to 2 months away. I'm just guessing. So you can see the difference. And imagine if that turned around and started rallying hard again. OPEC are cutting and all of a sudden the market gets in a bit of euphoria again, the oil prices start rocketing up. I'm going to get absolutely caned if I'm selling options in that type of environment, in a low volatility environment. It's just going to be really hard. And I have been caught like that. I got out of jail only just, but I did get caught when it whipped out from a low volatility to a high volatility environment. Um, and it's not nice. It's very, especially when you know there is no limit to what you could lose. All right. So basically, if you're so that was one way to trade options, and you could sell them there, or you could just straight out buy calls. But in this type of environment, if it's a stock, for example, say this, if we just go and delete all this. Now, has anyone got a bit of experience with options? I know, Paul, you're looking at getting into it. Just sorry, this is probably an easy way to do this. I've done this the slow way, haven't I? Remove all, done. All right. So say for example, we've got if you're a bit bullish on this market, what is it? Oh, sorry, on the Sydney SYD, just as an example, it's coming off. It's got a support zone there. Maybe we're starting to see. Um, maybe it's starting to break out there. You don't know, but you're starting to get a bit bullish. You can trade this with just buying options. All right, puts. Yeah, we'll go into that in just a second. See, with options, there's so many different ways to attack the market. we'll do two different scenarios just on this stock. For example, if I think this is going to go up, and I think, okay, we could get a bit of mucking around, but I think essentially it's going to go higher. If I start seeing the structure that I want to see, I might see a retest of these lows they're holding. We get a higher low. I'll just go and buy a call, outright buy a call, and my target obviously is up here. So then you're going to get into the nitty gritty of what's your strike price. And then with options, you've got so many different options just on this one market on SYD, the stock options, that you could go pick and choose what you want as your risk, because they all come with different prices as they get, the closer they are to the market, which is say 640. If you get a strike price at 650, a bought call, you're going to pay more for it. If it's 750, you pay less for it. Okay, so you really, you're just picking and choosing your risk. Okay, I want to spend a few $100, so I've got to have this strike price. Okay, I'm still bullish on it. It just means that my bang for my buck, I don't pay as much, but I also don't receive as much. Um, I'm not going to make money as quick as something that's at the money. At the money means right where the market is. So if I buy something at the money, I'm buying it right where the 640 say. I buy there. If the market moves my way, I'm going to get more bang for my buck, but I'm also taking a bigger risk. Okay, so really it comes to that point. Once you're direct, you've got your entry signal. You either trade the stock, you buy the stock outright, or you just buy a call. You buy a few calls. You may get the leverage to it. It's like trading CFDs, but the difference is, I guess, with if I bought some CFDs on this, um, I know what my risk is. I can get cut out there, but the thing is, I can get chopped out. It can spike down, wash me out. I get stopped out, and then it goes. The price will just, say if this is my support, I've seen it push up. It's consolidating. It's sort of bouncing around here. I get an entry signal. I might think, okay, I'll buy it through here. Say the market just washes out down here. I get stopped out, and then we get this type of scenario. Probably it's not so common, but I can easily do that. Just test that support, wash it out, and then go. On a CFD, I can easily get stopped out. That's the end of my trade. If I bought a call in here. It can come down. It could go. I lose money on my call, but then it turns around. It's back in the money again. Okay, so that's the beauty of options too. If you're buying options, you've essentially the only time if you just hold it until when they expire, you know exactly what you can lose, and you can get into a chopping market. You can get in a bit early. It can chop around. Whereas ideally, you could on a CFD, you might get chopped out a couple of times. You might give up, or the third time, lucky, you might make money. Whereas an option, the beauty of them is that you don't get stopped out because they can go to zero and then they can come all the way back again. Does that make sense there? So they've got some benefits, obviously. But the difference on the upside is that you're winning on a CFD. For every dollar move, you win a dollar. That makes sense. So you're winning one for one, whereas an option, you might be winning half for one. And that obviously increases the higher it goes. But to start with, you're winning a bit less. So for every dollar it goes up, you might make 50 cents and so on. All right, so that's one way to attack it there. Now, I think, John, you were saying you write puts. Now, I know a lot of people can say, well, you think, say for example, the market was here. Let's just do that. Say the market was trading here, and you go, look, I don't want to. I think it's going to go down. All right, but I'm happy to buy the stock. A lot of people use options like that, so they might just sell the put. Say a strike price around here, say $6 even. And what happens? It goes down there when it expires. They're in the money, so they can take, as long as they've got the money to pay for the stock. It's a way to enter the market. And for example, if it turns around and goes up from here, and you don't manage to get in, at least you've got some income for it from selling the puts. So a lot of people use that as an entry strategy. So you can see that there's any number of ways to use options. People do covered calls. I don't know if you've heard about covered calls before. So buying the stock, selling options against it. I think everything. So if you go back just purely to trading, everything has ups and its downs. So there's risk to everything. There's no easy way to make money, but there is pretty much for any sort of phase in the market, any how do you say, any market conditions. There's a very nice suitable strategy, and I think covered calls in a market that's moving higher. I wouldn't even bother, to be honest. I just buy the stock and let it go, or you buy calls and you just let them go. Maybe you keep rolling them over. So you're just taking purely, you're worried about the market going up. Now, if the market's in a sideways, longer term contraction, you can see that. I think covered calls is probably not a bad idea if you own the stock anyway. You buy the stock. like we were showing before, if the market's just banging, say this is just a broad range, you have the stock. So obviously we've got the picture there. It's stuck in a range. Longer term, it might be on a weekly, monthly basis. You don't know. It's sort of maybe it's picked up from lows, then it got stuck in a range. It's consolidating. So if you have the stock here and you know that you okay over longer term, I'm not going to get. I want to do something. I want to make use of that position. I don't want to cut it out. I think longer term it's going to go up. What do? You can just sell options against it. Every time it picks up towards the resistance, sell an option with a strike price a fair way away, knowing that there's a good chance you can see all your view on the market is going to hold that consolidation. It's going to keep within that range. That resistance is going to hold. So you're just taking income out of the market. Um, but the risk is if once it pops out, if you go through your strike price, you're essentially capping um, the appreciation in the stock. So there's times when covered calls can work, and there's times when it's probably not the best scenario. I mean, like anything. Does that make sense there? Does anyone have any, if you've got a question about it, because I know options can get complicated. I don't like to make them complicated. I think by understanding what makes up an option price and basically how to use them, there's different ways to attack them. If you're a pure stock trader, you're probably not you're going to be interested in selling calls. Um, but I think what I was doing on crude oil were working fantastic then, and in a whole year, you might have one losing trade. But then when you lose on calls, on naked options, you lose a fair bit more generally than what you make, if that makes sense. But generally overall, those few years was just really, it was not easy going, I guess, but it was just some nice trading in there using options. Yet if you just went and tried to trade it with crude oil, yeah, you could make money, but it'd be hard work. I think it would be harder work trading straight underlying the futures market because it's really whippy. It would really chop around. It would be really strong. It could spike up. That's great. It's going to keep going, then bang, come down and stop you out. I just found it a lot easier trading on the spikes. Yeah, I wouldn't. Yeah, exactly, Paul. I would stick to buying because then what you're doing. Well, I think what you'd be looking at is whether you look at your charts or whatever. It's the same as buying shares, selling shares, or trading the share price. You're trading the options to start with and because what you've got to do is get a feel for the strike prices and what the prices are, and then you've got to get a feel: are they getting expensive? Is the market getting a bit volatile? Um, should I be trading options? So you get a feel for the options first, and then selling comes. I think selling it gets risky. I mean, I haven't actually looked at options for a while now, purely because the crude oil options stopped working, so I don't even sell them. And I know we used to do vertical spreads, which is sell a call, buy a call higher, and then sell a put and buy a put lower. So you've got covered on both sides. So really what you want is just a market that's going to bang around in a bit of a range like this. And then you're selling a call here and you're buying it as cover and you're taking the premium, the difference. So you sell it for $2, you buy one for $1, you're making a dollar net, but your risk is just in between the two calls. And the same on the downside. So you're trying to net it, but you don't want a market that's trending as such because it just becomes hard work and it's just complicated. So there was a way to trade that was on indices. We used to do a lot on the FTSE, the DAX, the SPY futures as well. At that time, this was years ago. And there was a massive group doing that. Optioneer, I think, did a lot on the DAX and the FTSE. I don't know how they go now because it's sort of horses for courses. I don't know if a market that's trending high like that, if it's worth doing that type of strategy. Uh, what is the risk with CFDs? I know nothing about them. Are you charged interest? Yep. Are they riskier than options and how? CFDs, no. My background is futures and options. So I sort of started my career. I started into options and I worked my way backwards, if you can say that. From the what's considered risky to what's considered less risky to share trading. So I sort of started off trading anything, derivatives and things like that. So um, margin is a big thing, and you just get used to it. It's as long as you understand what the margin is. I don't think it's risky. CFDs is just a margin product. It's like options. It's like anything margin. As long as you understand what your risk is, and you're prepared for that, they're not risky. And I use you need to yeah, just understand your risk for different things. All right. So with CFDs, I think they're a good product. They let people get into the market that otherwise probably couldn't get into the market if you're just trading straight stocks. So if you want to trade the big boys like BHP, the banks and things like that, if you don't have the capital and to get into it and to make it worthwhile, then CFDs is a good way as long as you understand what the risks are on and where you're putting your stops. You manage your risk effectively. Now, in the way of you do pay interest because it's just an interest product like anything. That's the cost of trading. Um, I'm just trying to think of options. Yeah, options can be everything can be risky. I mean, if you don't understand stocks, how to trade stocks, it can be risky. I mean, if you buy it, think, oh, everything goes up. It could, like, if you were buying it just before the GFC, imagine if you're buying stocks there that were valued, they were good value at the time for whatever reason. You bought some stocks there, you might think it's not a risky trading, but you're sitting behind the eight ball for years now. I know people that have actually did it. Were buying up towards the highs, thinking we're stupid for not getting into the market. We stood aside at that time. Just thought it was getting a bit stretched. We stood aside. They jumped in. They didn't like what we're doing. They went somewhere else. We know they bought into some stocks. They got into whatever they got in, and I'm sure I don't know if they're holding them now, but they hold them through the GFC. That to me, even everything comes with a risk. You just got to understand the product. If you can understand options, you understand how to use them. Again, it comes back to the market and how it moves. Um, Now, Devin's just mentioned with options, if you want a good read, he's actually written a book on options. Um, it's called Options Made Simple by Devin Clark and Jacqueline Clark. You can get it on Amazon. If you Google it, actually, I did Google it. Let me just quickly get it. Made Simple. So it's a good little read on Amazon. I'll just open this up and I'll put the link on. Oh, geez, that's a massive link, actually. Yeah, I won't wait till that link is far too big. But anyway, if you go to just jump on and go to, if you just Google onto Amazon, um, you'll be able to see it. Options Made Simple. I'll put it in the chat. It's a very good read. Geez, what did I do there? Made Simple. Just Google that and it'll be by Davin Clark. You'll see it there. I think it's got a purpley covered book. Nice colour, by the way, Dav. Oh, no, it's blue. A lie. It's my eyes. All right. Yeah. So back to what you were asking, Paul. Options, are they riskier than CFDs? I don't think so. Like I said, just depending on how you trade them. Like futures are the same thing. We don't consider that. I mean, some people consider CFDs a risky trading CFDs, but it's the same as trading futures. Now, people have traded futures a lot. Um, yeah, Dav, can you answer that question? I think you can. Found the soft copy Kindle, you can download to PC. Probably can, yeah. Um, yeah, so I'm just reading through the comments there. So, any other questions on those guys? Um, Again, like another big market is FX. That's a margin product. That's a massive market. There's a lot of retail guys in there too. They love trading, and that's not considered a risky market. It's in my opinion, it's who's trading it and how they're trading. It's a risky thing. It's not the actual asset itself. Trading options, everything comes with risk. All right. So I hope people got something out of that. I think options can be, like I said, they can be a very useful tool. There's so many different combinations to attack options and to use options if you utilize them. But I think the way you utilize them is dependent on the market phase, the market conditions. Um, and you wouldn't use the same techniques all the time. Sometimes they're going to suit, like I said, covered calls. I think in a trend, yeah, in this type of scenario, I think it's great. You've got some stock. If you've got stock you're holding, sell some calls against. You get the extra income if it's doing nothing. If the market's even going down, you don't want to sell out of your position. You're holding it for whatever reason, longer term. Get some income from it. Sell some calls. Because if the only risk is really if the market kicks up and goes through your strike price before expiry, then you might have to, you either just buy it back at a loss, but you're sort of locked in, your stock's going up anyway. So it's horses for courses, I guess. Does anyone want to, just before we call it a day, do you want to put in some stocks we want to look at? Has anyone got something they want to look at, or just see what it would be to do with options as well? Let's just see where this market is at the moment. Up 15, grinding away. This is one we were looking at yesterday. Wouldn't mind it pulling back. Probably could have got in yesterday and been up 5 or 6 cents at the moment, but yeah, it was just getting a little bit ahead of myself. Got a bit of ahead of us then. That's why we didn't jump in. All right. If anyone's got there's no sort of stock codes we want to quickly look at, then I guess being a Friday, it'd be nice just to knock it on the head. I guess everyone's looking forward to the weekend. Anyone got a big weekend planned? Not you, Dave. I know you have. I know I got pretty much I've got some mowing to do if it stops raining. CBA. All right. Well, actually, I don't know if you've got this, Paul, or not. Have we looked at this before? Look at CBA in the way of options. You look at this type of. Let's go back to a weekly. Let's just get it in there. See this type of environment here could have been a nice little way if you held stock. If you hold it, say you're holding it longer term in your super or something like that, getting an income from. Even though every time it picked up, you think it's going to capitulate, you can sell some calls up here, sell some calls. Obviously you've still got to have a direction. Sell a call. Yeah, there you go. But it could be the only difference I see with this is say it's how it's getting extended there, Paul. Let's just get this price action, but it's broken some highs. For me, if it was, just try to think of a scenario. So at this point here, just the end of 2015, it sort of worked its way back up. The MAs were still down, so for me, that's a negative market. It's getting up here. It's still holding below this lower high at 88. Probably a good time you could have sold some calls there if you're holding the stock. If you're thinking that that's going to roll over, even if it starts rolling over here, selling some calls, expecting it to trade back down to 70, letting it expire, get the income that you've generated from selling the calls. I don't know what. It's probably, I don't know what percentage. I think they were around 1 or 2% maybe. You could have got 2% on your holdings. If you've got 100 grand of that, you sell 100 grand's worth of options. I think it's around a couple of percent return you could have got. I'm not sure. Don't quote me on that. I don't even know the figures, to be honest. But yeah, that could have been a good option. Here, I think we're coming off a solid base around that 70 mark. So I think you've just got to be selling them here. It could be in a different scenario. This market could just keep grinding higher. So if you've got the stock and you're selling against it, look, you could take some income, but the chances are that this thing just keeps going higher, depending on where you get your strike. Yeah, exactly. So it's breaking through that 79 zone. So I don't mind this. I still want to see a bit of. Let's just draw it up. We'll just draw it quickly just to get an idea. So the way I might view this with options. Sorry, I gotta get my glasses back on. All right. Now, so you got a lower high here, you got a lower high here. The market's held up at 70. Say at this stage, if you're selling options in here, great. You've got that move down. It's picked, and the market you can see here was getting sort of stretched at that time. It's getting a bit overbought. So yeah, good scenario. You could, especially if you're getting your strike up here. If you're getting your strike at a decent enough above, especially above this lower high, if you're selling and you've got some stock, you may have held it way back here, you may have held it longer term. This is a negative market overall. It's moving lower. You don't know what's going to happen. You sell some calls, you get the income. At this stage, what we're seeing now is just popping up through that resistance zone. It's going to still find a bit of resistance up towards 85. If you could sell some calls at strike prices, say at 90 or so, it could be a scenario, but you may not get much for it. You have to weigh up. Again, it's your risk reward on anything. You wouldn't sell them naked. I would never do that at this type of scenario. So you've come down from these highs, some highs right up here at 96. So really the market on a longer term basis, it might be stretched to the downside. It's finding a good base. So just to sell a naked call would probably definitely not the right thing to do, I'd say. Buying a call could be a way to attack 85 if you're just trading pure options. But if you've got some stock and you're thinking about income, again, you've got to weigh up what sort of income you're going to get from the option and what is your risk. If you have to sell something about 83, that puts you smack below that that next probably target of 85. So if you've got the stock, you just probably wouldn't even bother, because then it comes down to, is that going to happen? Is it going to get up to 85 before your option expires? If you can guarantee to yourself it happens after it, okay, then you take the option, you take the premium. The market's still hanging around 82. You got the premium. You take the stock is actually appreciating as well. But if it doesn't, if you can't sort of say to yourself, in all fairness, that this market's probably going to go through 83, the strike price, before they expire, then you're better off just holding plain stock, because all you're doing really, you've got some income, but you're capping. All of a sudden, you're capping your stock at 83 as well. So does that make sense there, Paul? Or to everyone else as well? But yeah, that overall, I don't mind CBA at the moment. Like we've spoken a lot about the banks. Well, we've spoken a bit about the banks anyway. I tend to exaggerate a bit. Look at Westpac too. That for me, if you just traded calls, I wouldn't mind that. Just buying calls. You've had that contraction there, then it built some higher lows, and that led to a good leg higher. Maybe that's what could be happening now. If you want exposure to it, you just want some good exposure with little risk, you can trade the options. It's exactly like buying the stock and putting a hard stop in there, knowing exactly what your risk is. Yeah, knowing exactly what your risk is. Say on Westpac, for instance, you buy the stock, you've got your risk here. I know exactly what I'm going to lose. Or I can just buy some calls. I know exactly what I'm going to lose, and then I take advantage of that move higher. But either way, I've got an idea of which way it's going. I'm guessing, or my not guessing, my educated guess, or my analysis, my view is that the market's going higher. Okay, we held that zone through 28. We've got some higher lows pushing up. We've taken out some minor lower highs. We're starting to get showing signs of buyers are happy to step in. Blah blah blah. It's going to take us up. That's my view. I would just buy calls. I wouldn't even bother thinking about selling anything. Or if I had the money, I'd just buy stock. Right, so that's I guess the difference in what we said before. If you bought, and you could buy the CFD also, there's nothing wrong with that. It's just like buying the stock. You've got to know where your risk is, and you've got to know what you're risking and what dollar value you're risking. If you're happy with that, you're happy with your risk reward, okay, nothing wrong with that. Go for it. Because I guess the difference between the CFD and the stock, even if you do pay interest, you get more bang for your buck. I don't know, was it 5%, I guess? So for a 100 grand position, you're essentially outlaying 5,000, I think it is. Correct me if I'm wrong, Dave. 5 grand for exposure of 100,000 on Westpac. And, or if it's not, it's 10%, I can never remember. 10 grand or 5 grand in margin for 100 grand. If you stock, you got to pay 100 grand. So your bang for your buck is good. You can do that for a smaller account, but you still got to understand what your risk is. And in dollar terms, if I want to risk, say, $1,000, that might be so the number of shares I get or the number of CFDs. If I put my risk there, what's that going to mean to you? It could mean $1,000 loss. Okay, I'm happy with that. Go for it. Or you're buying your option and you're trying to take advantage of that move. So, like we said before, horses for courses. But there's different ways of attack. If you know what the market's doing, you have an idea, then you pick your tool. Pick your tool to trade it, whether it's a CFD, whether it's straight stock, whether it's options. I don't know what else you got to trade Westpac, for instance. All right, guys. Anything else? Anything else we want to chat about quickly? Just before we call it quits and we get stuck into that weekend. Let's just see where any of these others are moving. We've got some movement. This one here. Don't know if anyone's following MVP. We're avid followers of this one. I think the story is fantastic. Look at it today. Don't be surprised if some good numbers come out soon. They're looking for, I think they just had approval for their drug to get sold into Taiwan. I think that was the recent news. Pentox approved for sale in Taiwan. Yep, that was yesterday. Didn't do too much yesterday, but look at it today. Bang. I think the big approval comes through FDA approval into the US. So if that one kicks on, it's going to be great. Just getting a feeling that somebody knows something there. If they do, that's great. It kicks it on. All right. Market's up 15. We'll call it a day there. Hope you all enjoyed that. If it, like I said, Paul's just whacked in that as a query. He wanted to have a bit of a chat about options. If there's anything else, I know we did have something else. I think John, it might have been. It might take me a bit more work just to look at stuff. I think it was on what was it? You can talk about exposure, building stocks with exposure to building or exposure to the US. A bit of research, and we'll chat about that as well. All right. Thanks very much, guys. And thanks to you, Paul, for actually putting in that idea. Have a great weekend, and we'll speak to you on Monday. Cheers, guys. Bye.